Alrighty, welcome traders. We're going to go through Tom's trade rules. Rule number 7, never average down or add to a losing position. I know that may be a tough one for many of you, but we'll talk about it. Only add to winning trades up to your maximum loss and proper sizing, but never average down or add to a losing position. Let's get into why. All right, so averaging down. Averaging down is a trading strategy where, again, a trader may buy more of a particular asset as its price declines, with the hope that with the average cost now being lower, that the asset's price is going to reverse its course and go higher. However, hope is not a trading strategy. While some investors and traders might see this as a tempting approach to potentially increase their profits, it's really a pretty risky strategy. There's several reasons why you should never do this, or at least be cautious about averaging down. Again, you're now taking a losing trade and you're plowing more money into a loser, hoping that it'll stop being a loser and try to be a great winner at some point down the road. Or maybe you can break even. Not in this business to break even. I'm either winning or I'm cutting my losing trades. But averaging down is not a strategy that's going to help me a whole lot. And here's some issues that happen when you're averaging down. Number one, catching a falling knife. Averaging down can be compared to trying to catch a falling knife in the market. Just because the stock's price has declined doesn't mean it's hit bottom or it's going back up. You got a 50-50 shot every day of the market going up or down on the stock. If an asset starts to go down, it could continue to decline, resulting in further losses. Averaging down often goes against the trend, which is generally going to be a much riskier approach for you. Why are you trying to add more money to a position that's already losing? Again, hope is not a strategy. Number two, emotional bias. Okay, emotional bias. Here, averaging down can lead to emotional bias in trading decisions. You can become emotionally attached to a particular asset and convince yourself that it's eventually going to bounce back. Hey, Apple's down 8 points today. Okay, I'm going to average down because now I can own it at a $4 loss and not an $8 loss. Okay, who's to say Apple doesn't go down another 15, 20 points over the next month or so? You're going to keep averaging and throwing more money more good money after bad because you're attached to that particular stock. You've got to stay emotionally, Switzerland here. You've got to get out of being emotionally attached to that particular trade. Number three, opportunity cost. When you're busy averaging down on a losing position and you're plowing more money into a loser, you're missing out on other potentially profitable opportunities in the market on other assets. Okay. While you're trying to average down on that Apple loser, you're missing the fact that Amazon is a winner. Okay. You could be putting your money into Amazon. You could be putting your money into Oxy. You could be putting your money into the S&P. You could be going anywhere besides adding to a loser. Okay. You're missing out on other opportunities. It's tying up your capital that could be deployed in a much more promising investment. Okay. Number four, there's no guarantee of recovery here. Not all assets bounce back right away after a decline. Some might face fundamental issues, fall out of favor. The sector could be bearish. There could be negative news on the market that turns the whole market bearish. In these cases, averaging down only deepens and magnifies your losses. And the losses can become exponential. As an asset's price declines, the losses can increase exponentially, and now you have twice as many shares. Or you average down again, and now you have 4 times as many shares. When you're doubling down on a loser, you're magnifying your overall loss if the trade does not reverse in your favor. Okay? Don't magnify your losses here. And number 5, the mental health aspect. It can take a psychological toll if you have sustained losses from averaging down. Okay? That leads to stress, frustration, and potentially can impact your overall mental well-being. Again, averaging down and watching it continue to fall, okay, is going to put more stress on you. You're going to start to make decisions that you shouldn't be making because you're under an emotional strain. Okay? You want to stay, again, emotionally calm You want to distance yourself emotionally from a trade and just trade your plan, which does not involve averaging down. Okay. So instead of adding to losers, here's what I recommend. Okay. Number one, accept the loss and simply move on. Losses are part of trading, and traders should understand that it's normal to have losing trades. Accepting losses and learning from them is crucial for your improvement. Learn when you lose. Have a plan and stick to it. Just move on from your losses. Have the memory of a goldfish, 10-second memory. Hey, I lost in a trade. I'm out. I'm done. Okay. Just accept it and move on. Number two, stick to your trading plan. If you have a well-defined trading plan, okay, it includes your entry and exit strategies. It's going to help you maintain discipline and minimize any emotional trading that you get into. Follow your plan. It's going to prevent you from averaging down losers, which is essentially entering trades that no longer meet your criteria. If the trade's a losing trade and you're trying to average down, if you weren't in it, would you be adding to it at that point in time? Most likely, no. It's no longer fundamentally where it was earlier. Okay. It's no longer where it was when you thought it was going to move up. It's now moving down, and most strategies don't tell you to get into something when it's going the opposite way from your criteria. Stay mechanical in your approach. Number three here, only add to winners. Okay. Up to your maximum loss and use proper sizing. So instead of adding to losers, try adding to winners. On pullbacks in the trend, if your criteria is still in play, you can add to a winning trade and up to your maximum loss risk part. So you can add to winning trades, not when it's losing substantially, but if it's winning and you get another chance to get in, like a pullback in that uptrend, jump in with some more. You can average up if it still meets your criteria. If it's at a good spot that you would enter it a second time and you're still in the first trade, you can add more. This can give you better probabilities and make you more as you average up on a trade. So I consider looking at averaging up, even though that's not my favorite strategy anyway. I consider averaging up on something that looks promising than averaging down. If I'm looking at a chart on Microsoft or Apple or Tesla or Google or the S&P or name any other underlying, if I liked it at one point and it's moving up, okay, and it still looks like a good entry point, get in add some more to it. Okay. Most people will scale back and start to let leg out and let a runner run. That's totally fine as well. Nothing wrong with that. But I'm definitely not going to add to something that's turned and run the other way, and now it's a loser, and I'm going to go throw good money after bad. So stay away from adding to losers, okay, and only add to winners if you feel the need to even do that. So while there might be instances where averaging down can work out, it's generally a risky strategy. It requires a lot of things to go right that were not part of the original trade. In most cases, it's wiser for traders to cut losses and move on to other opportunities rather than trying to salvage a losing trade that can result in the death spiral of that trade. You're just adding money, it keeps going down. You add money, think it's going to turn, and it goes down even more, and now you got exponential losses. Okay. Remember my saying, success in trading comes from the ability to control your emotions and follow a plan. If you put this on your wall, you post this on your laptop, success in trading comes from the ability to control your emotions and follow a plan. All right, so take trade rule number 7 here, put it into action, stop averaging down, start making more money. Take care, everybody.